Half an hour until the opening bell on Wall Street. Despite the recent churn in the markets, our next guest says he's sticking with the tech and consumer sectors. Joining us, Jake Walthour, CEO and co-founder of Blueprint Capital Advisors. Should point out as well that futures have been slipping over the last hour or so. We're down about 0.5% as we stand. Jake, good morning to you. My first question is whether you're concerned by the sort of intraday action we've seen in the last week or two, particularly that final hour of trade where we're tending to close at the lows of the day.
Sure. I am concerned. I think the market has recovered here in a very, very short period of time. When I think about the fact that, it took us less than a year to recover all of the losses from this global pandemic, I have to say to myself that the market's getting tired. And it's struggling nowadays to hit new highs and to stay at those high levels. And that's a sign. That's a sign that investors are starting to get jittery. They're starting to get concerned about the current valuations. They're starting to get concerned about interest rates. But more importantly, they're also missing positive news. Right now, all the positive news that we needed to come into the market to lift it to these new highs is out there. We have more than enough vaccines to go around, and those are being disseminated. Maybe we're not hitting the goals that we'd like to hit, but they're being disseminated. We got the stimulus package that we were looking for. And right now, the market's just looking around and saying, okay, what's next? I need something else to act as a catalyst to take this market to the next level. And so I don't see that something. And so I think from here out, we're going to struggle. And we're probably due for what I'll call a benign correction, where some of the excesses get shaken out of the market and we form the foundation of another leg of the bull market in the second half of 2021.
And so, Jake, what level of pullback are you looking for that would get you to be buying the dip? And what sector or stocks are you focused on to do so when that occurs?
Sure. I'm still sticking with tech and consumers. I still think that those have the most wind at their back in the middle of this pandemic. And I think that the earnings numbers and the GDP numbers in the second half of 2021 are going to be very supportive. Until then, I think that we could see, somewhere around a 20 to 25% correction. We're seeing 4, 5, 6, 7% moves in some of these tech names on a daily basis. And so I don't think a 20 to 25% correction is out of the range of expectations. In fact, again, I think that would be absolutely benign for the market from here.
And Jake, just finally, the sort of SPAC complex and the ARK universe, is that an area you want to steer clear of?
We've been doing a lot of work on SPACs and really trying to understand them. They've been around for a very long time, but appear to be a new phenomenon as a way of raising capital, as a way of doing acquisitions. For the meantime, I think we're going to stick with good old-fashioned common stocks and stay away from the SPAC markets, because I don't think the market truly, and when I say the market, I mean not just institutional investors, but retail investors truly understand the economics of how SPACs work. And so it's another craze, it's another phase, and let's see if it's just going to be a fad or if it's here to stay. But for the time being, we're sticking to common stocks and staying away from SPACs.
Shepard Smith here. Thanks for watching CNBC on YouTube.